Hello and welcome to the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Trey Bino, certified financial planner and chartered investment manager. I'm a financial planner with TC Wealth Management and Aviso Wealth. For more details or to send in your questions, check out the show notes on my website, treybino.ca/podcast. If you want to learn more about me, start with episodes 1 and 2. Let's get into the fourth episode. I'm joined here with Cease again.
Hi.
So this episode is actually something that uh, we've talked about on and off for years, but it's a pain point I have in my industry, and that's on the way, and I don't like to be a downer on my industry, but there are certain practices in my industry that I absolutely hate.
Mhm.
And I think it's a huge, huge disservice. And I think it's really predatory for clients. And one of those is, and I don't like to, I hate on a product itself because there are good uses for certain products.
Like, this might be a generalization.
Yes, but I would say I am still waiting to see a really good use for this product.
Okay.
And that product is called a segregated fund. And basically, we'll go over kind of what they are, but it's most common seen in certain types of companies. And in essence, they are a very expensive way to invest. But for that expense, you get certain benefits. Unfortunately, those benefits, in my opinion, are nowhere near enough for the cost.
Hmm.
Okay. So some of those benefits and the way they're sold, I think is very misleading. So for example, there is often a guarantee of some kind of the principal when you invest.
Okay.
And what people assume is that this guarantees what they have invested, but that's often not the case. So it's, let's say you put in $1 million into this type of product, and the guarantee time periods will range. Maybe it'll be 10 years or 15 years or whatever it is. But basically, you are guaranteed what you put in after that time period has elapsed.
So if you invest or if you put into the product $1 million and the contract says 15 years, you'll definitely get that $1 million, even if, uh, I don't know,
Even
something.
if the markets are down or whatever,
Right.
right?
Okay.
Is the point. That's the allure of the product. So it's kind of like a guarantee.
Okay.
In reality, though, there are a few stipulations around that, but I'm yet to meet somebody that has seen them pay out at any, but because that time frame is so big, that the reason that the insurance companies can take that risk is because the chance is very, very low
Yeah.
of that actually happening.
Right.
Um, Especially in the type of investments that you put inside of them. They're often like very large mutual funds that have, so you have a choice between buying the segregated fund version with some of these guarantees and then the non-segregated fund version.
And is that
Um,
like, would that be through you, the non-seg?
Anybody that is licensed to sell mutual funds would be able to sell the non-segregated fund version. But oftentimes when I see this, it's because the advisors, I say that
Loosely.
loosely, um, they can only sell insurance products. They're only licensed to sell insurance products. They haven't done the exams required to be licensed to sell mutual funds. And mutual funds is like a step below what there's a huge variety of different investment options out there.
Yeah.
Mutual funds is kind of like
That to me
the
is like the
first step.
starting. Yeah.
It should be, uh, but insurance companies kind of got into it, add their twist on it, so that they can also do these type of products.
So that for an insurance company, they can only sell seg funds?
Yeah,
Okay. So
if
if
they're
you're
looking at investment options. Yeah.
okay. Hmm.
So what ends up, I wouldn't say insurance, somebody that is insurance licensed can only sell seg funds,
Yeah.
right? Um, yeah. The other benefit, so there's the guarantee benefit. The other benefit that is, I could genuinely see like, okay, this could be a benefit is the way that it's handled in an estate. So for instance, in a TFSA, like a regular TFSA, you can name a beneficiary. That means that the funds within that TFSA pass outside of your estate. But on a non-registered account, you can't name a beneficiary, which means that those funds will typically flow through the estate. That means that it's subject to probate and things like that. Well, with seg funds, it's actually an insurance contract. So therefore, you can name a beneficiary on it and it can pass outside of the estate, which means that it's settled significantly or can be settled significantly quicker than
Having to go through
having to go
probate
through
and the
probate
estate.
and all of that type of thing.
Yeah.
So that is another benefit that I'll show you the numbers, but again, there is a benefit there. Definitely a benefit there.
Yeah.
You just, if you're going to say, yes, that's the benefit I want, you have to understand the cost of that benefit.
Yeah.
And that's the key thing is where I'm talking about this because uh, I've now in the past month or so seen multiple and it's typically like parents of clients and things like that that like showing me these statements, not really understanding what they're paying and
And what they're paying for.
what they're paying for.
I already want to say the benefit of avoiding probate. I feel like people use that as like a way to sell products in the financial industry way too much. Like in the sense of people just want to avoid probate, but they don't fully understand like what probate is and how much it actually costs.
Yeah, because there's some places where it's very expensive.
Yeah.
In Saskatchewan, it's not at all. Um, it's just again, it's overused, which is why I think it's disingenuous the way that these products are sold.
Yeah, because if you're like, "Oh, you can avoid probate," and people are like, "Oh, I've heard that
It's a pain in the
probate
bum. Yeah, everybody hates probate. Nobody likes
no
probate.
probate," but do you really understand, or have you just heard that, like, "Oh, you want to avoid probate," so, anyway, sorry, that's just a side note for the benefit, I guess, because I'm hearing not a lot of benefit for what you've told me the cost of these are.
Yeah, but that is a big one. I can see it. Um, and where this is most, I want to be very clear. Like where this is most often seen is in when insurance companies try to do wealth management because they're an insurance company, and then they're like, oh wait, we can also do this way. And some of the biggest offenders that I've seen is I'm going to name and shame. Screw it.
Okay.
Is there's a company called World Financial Group. Um, they're really notorious. And if you're thinking to yourself, if you're not with like a major bank or something, I can't believe I'm saying this, but I would rather people be with invest with banks than these type of companies. But if like for example, World Financial Group, uh, you don't have your laptop there, but let me just let me Google them. First thing that comes up. So World Financial Group, first thing that comes up is life insurance. Red flag. Huge red flag. If you're looking up the company that you're dealing with and the first thing that comes up is anything to do with insurance, it should be a red flag. And it doesn't mean that necessarily your portfolio is terrible. It means that you need to be more aware and more on guard than you may need to be if you was dealing with a, another company that wasn't an insurance company first.
Quick question, side note. So a certified financial planner, they have the fiduciary, is that right? That word?
No, they're not in. They have a higher standard of higher standard.
But you
There's a
have
higher
the
standard,
fiduciary oath.
but that's because I joined FPAC, and
Okay.
that was a major reason why I joined them was because I wanted to be held to that standard.
Right. Okay, sorry, because I was just thinking that might be part of the insurance
No,
thing, but I guess
a lot of it is to do with, I think, education. There's genuine advisors I've spoken to that think they're doing the right thing.
yeah.
But all you have is all you have is a hammer, everything's a nail. It's just like, this is the solution. This is what I'm told to sell. This is what I'm selling for everything. But that's the difference between a financial planner, like a true planner, and just a salesperson, right? But going on to the World Financial Group's website, first thing it says is World Financial Group is primed to help you prepare for the long term with insurance, education planning, and retirement strategies. Insurance is first. And then you look at so Quadrus. Quadrus is owned by like Canada Life. They used to be Canada Life and Great West Life. They kind of merged. It used to be Freedom 55. And again, Freedom 55 was about an insurance product that you could do. But anyway, and Quadrus is another example where they are owned. Slightly better though, because when you go onto their website, they are investment, like they are an investment firm, but because they are owned by an insurance company, I would be more cautious than otherwise. I've seen great portfolios from Quadrus. From people that work there. I've also seen terrible ones that are in these type of products, very expensive, where the client didn't really understand the actual true cost of this. And then you compare it to, I don't want to be super biased here, so let's use like Edward Jones. Edward Jones is like probably a big one that people know of. But you go to their website, and the first things you see are retirement planning and things about investments and how to choose a financial advisor. And it's not trying to sell you insurance
Product.
or a product even, right?
Right.
It's they still do insurance. They still do lots of things, but they are a wealth management firm first, right?
Right.
And that's my caution. And there's others like Fairfax Financial, La Capitale. These are all, and it like La Capitale. I can't even find a web page for them. But when you Google their name, the first thing that comes up is just a bunch of insurance. Like if you go like La Capitale Saskatoon, which is where I'm located, it's just insurance broker, auto insurance agency. Like it's insurance. These people are insurance first, and investments and things like that second. So would just be more careful around this. So I'm going to use an example to show you the cost difference. This is one that I was looking at this morning, as actually, hence us doing this podcast, because I'm annoyed about it right now.
Yeah. He was.
So this was comparing two. So this was with IA Financial. So that was WFG. Yeah, this is World Financial Group. So they work with a few different few different insurance companies is like their main source of options, I guess. And I was looking at a Fidelity fund. Fidelity is a fund manager, like a big asset manager, one of the world's biggest asset managers, in fact. And they had a segregated fund, like this client had a segregated fund version of this fund, of this Fidelity fund.
Okay. Yep.
Okay. So, so this Fidelity fund, and it was the series that they were in was costing them 3.38%. So 3.38% every single year is what this segregated fund was costing them.
Yikes.
The regular, which is high for sure, that's crazy. But the regular fund costs 2.23%. So that's what type of difference is that? That's over 1%. So over 1% more is what they're paying for this segregated fund section.
So they could have the same fund.
Yeah, so the same managers, same investments within the fund, but the fund version of it doesn't have all these added bells and whistles.
Which is simply you can have a beneficiary and avoid probate, basically.
Yeah, there's other ones like you can potentially, like it can be a creditor protection, and like there's like a mature like often there can be like a death guarantee. Like, if you put $1 million in today and markets drop and tomorrow you die, well, they'll often, like, depending on the way that it's structured, some of them you'll get that full $1 million back. Things like that, right? Like there's like an insurance component tied into it.
Okay.
So that I'm not saying that there are no upsides to it,
Right. You're not.
just that you have to be aware of the cost of these upsides, and especially when the upsides are unlikely to happen. If you're in your 50s, you have, like, the average Canadian makes it to the 80s. So you're talking like a pretty long time frame of paying these significantly higher fees. And the question is, maybe it is worth it to you, maybe it's not. You should be aware regardless. You should be aware that this is a thing and what this truly costs.
Yeah, because it seemed like earlier today when you were telling me about this, when you wanted to do this podcast episode, you were saying he was looking through a statement, and the way things are worded and the way things are shown to the client is not transparent or easy to understand. It is factual, but it's very complex and on purpose, I would say. Because why not just say the simple facts?
Yeah,
Why
it
is
didn't
it
even really
so
show that. I had to dig to find the fees of these things.
right?
Like, it's just
So it's like, do people actually know what they're paying for, and do they actually know what they're paying?
most people don't. Most people don't. I would say because if they did, it's very likely they would make different decisions. If they knew, right? So, yeah, I wanted to show the difference. So let me bring it up. Bring it up here. This fund, I thought I had it, but I think I closed it because I wanted to compare the two. Okay, so over the past, this is comparing the two. So the one that has the 3.38% fee, which is the IA North Star Fidelity Fund, and then just the regular Fidelity North Star Fund. So the last 10 years, the regular Fidelity Fund has done 6.82%. And because of the extra fees, the other one has done 5.67%. And we might think, okay, that doesn't sound that crazy.
Mm-hmm.
So I'm going to put it into dollar figures for you. So let's say you started off 10 years ago with $500,000. In the North Star, the regular fund, you would now be at $929,421. And in the other version, you'd be
Seg
at
fund version?
the seg fund version, you'd be at $835,183. So that's almost a 90 something $1,000 difference.
Yeah.
And the question is that difference worth it? Because that continues to compound, right? So I only have up to 2011, I think, 2011 on the seg fund version. But if we go back to inception, so that 2011 started, and let's say you put that $500,000 in now, the difference is now $1.716 million for the regular version versus $1.481 million
Or the seg fund.
for the seg fund version.
So what's the difference there?
Grab my calculator here.
Sorry.
That's a $235,000 difference.
So essentially you're paying a fee over time of that much money. Like,
Basically, that's the cost of them extra benefits. So when yes, it might be, oh, there's all these benefits and this is great. That, like, this is the expected cost, is that compounds more and more and more over time. So the question is, really, if the selling point is that it can go through probate quicker and it doesn't have to, sorry, it doesn't have to go through probate and you can get your money into your beneficiary's hands quicker, etc., which is the most common one. That's the insurance piece of the guarantees is significantly less likely to happen. Like, again, I have not seen it. I would love to know the statistics. I've never seen the statistics, and I've had insurance companies really tried to pitch me that to sell these products. So if the statistics were good, I feel like they'd lead with the statistics, of the
Yeah.
amount of payouts. So I'm sure they have them, but I don't really see them anywhere. If you're a wholesaler or something like that listening to this, send them to me. I would love to see the statistics about how often those guarantees pay out because I would love to.
Sorry, I just have a question. So when you're talking about the guarantees, is that for the time period? So the time
Yeah,
period has come up and the markets are down
yeah.
so
Therefore,
much so because the period of time is so long.
yeah.
So it's like, is it really going to be down the principal for that long? The markets, I mean,
I mean, you're talking about a major, major, major.
you just happen to be in what, like 2008?
No, no, not even then, because it's 15 years, right? Or like that type of time frame. And the ones that are shorter, like let's say it's like 10 years, normally they like guarantee up to 75% or something like that. Like it's structured in a way that regardless, it's unlikely to happen.
Kind of does feel a little
Sleazy.
yes.
Yes.
Like I want to say I can understand this from a marketing point of view, in the sense of the way they're structuring things is to capitalize on fear
Yeah.
for people. So, like you said, there are sometimes uses for this fund, but a lot of what I'm hearing from that lens is just because the marketing is my background. That's what I'm thinking about is they're using these tactics to kind of fear monger people into buying these products thinking and knowing that they don't understand fully, if that makes sense. Like they don't understand the markets enough, or the fact that if they're invested for that long it's so unlikely that they're going to be down principal they've originally invested by the end of that time frame.
Yeah.
And they know the people don't understand that, so they're using that as like a lure to get people to buy this product.
That's the way it feels to me as well. It does. It feels like no reasonable person with full financial literacy to the same level that somebody like I have would pick this type of product to invest their money in
Yeah.
without
Serious reason.
serious reason. Like because of the cost, because of the like, it's not like, oh, there could be a cost. No, like there's going to be a cost. The higher fees, especially at this type of level, like it makes your downs bigger, it reduces your ups. Like it's because of the fee, because they're taking it every single year. Like I know fees are not everything. I get that, but you have to be getting the value for the fees that you're paying.
Yeah.
And the vast majority of people don't actually see, don't experience any value in there because and I would say if they guaranteed it, like if it was like every year it was guaranteed for the beginning of that year, like that was the way the guarantees worked, I would be like, okay, maybe the fee is worth it at that point, Like that peace of mind to know that January 1st, if I ever need that money,
I get it.
I get it. I could see the allure of that. But because that's not the way that it works, but I feel like that's the way people think it works.
Yes, see, and that's what I'm having an issue with, is that it sounds like they're really complicating something and not being clear and confusing people, almost like there's no transparency on what. That's what it seems like. Just because you were telling me little bits and pizzas, pieces from the statements, um, where it was very confusing, even though you did the math because you're looking at it and you're like, it's true, but the way they said it is very complex. So somebody me looking at the statement, well, I'm like, what is this? What does this mean? I always come to you. Like, what does this actually mean? What is this percent here and that? So I could see people just ignoring it.
Yeah. Or they'll my favorite one that they do is they'll have like, and it's not just insurance company, but this one gets me, is where they'll have like a column for fees and there'll be zero. And then there'll be a little asterisk that says doesn't include investment costs, doesn't include management fees, or doesn't include product fees, or something like that. Where it's like, so a client looking at this statement is going to see a column that says fees at zero. That's where that's where most people are going to stop.
Yep.
And it's like, and then the product has a fee of 3%, almost like, I to me it's yeah to me it
That
makes
just
me sick.
feels
It makes me I there's a few things in the industry that just, and that's one that makes me mad. It makes me really mad because it feels very predatory. It really does.
yeah.
And if only people knew. And you know what? Like the industry as a whole is going in the right direction. We have gotten better and better at disclosing costs and fees, and it's driving fees down, which is good ultimately for clients. Like we are going in the right direction. But because these are insurance products, the rules are slightly different. That makes me mad as well.
Mhm.
I wish you absolutely, unless you had your basic mutual fund license, in my opinion, you shouldn't be able to sell them at all.
Well, this is kind of scary almost because it sounds like an industry that you think there's going to be a standard in. Again, the average person doesn't understand all of these industry standards, and I would
The
imagine a lot of
difference
people.
between the insurance
It's
regulators
like
versus investment regulators versus used to be like the MFDA, the Mutual Fund Dealer Association versus IROC, and then they merge. No, no,
do
people
you
don't
even know what those
understand that.
acronyms are? Yeah, like
No,
I'm saying, even for you, when you're like, "Hi, I'm a CFP. I have my SIM." Like all those things that you say, I feel like I can not guarantee, but it's likely that most people are like, "I have no idea what that means," or like, yeah, maybe they know what it stands for or whatever, like, but what does it really mean, right? Do people even know what a fiduciary oath is? I don't like. I'm sure a lot of people would, but do they know that not all advisors take one? Do they know
most
that's
don't, right? But they don't know what it means. They don't like that. There's and you know what? I think that the industry has also done a really bad job of differentiating, um, and like being like because to most people, all people that do anything to do with financial products are the same, right? They couldn't really tell the difference like that between somebody that works at a bank and their job is just to sell that bank's own mutual funds compared to an independent financial planner that does the only planning compared to somebody like me, which was on the security side that could do stocks or ETFs or what, like have more options to compared to an insurance agent that all they can do is seg funds and sell you whole life insurance. Like there's people struggle to understand the difference,
I
but it's
would struggle, and I'm
yeah,
like, I'm married to you.
but it's unfortunate that the where you choose to make who you choose to trust with these decisions has a huge impact. And you know what? It's not even I don't even really blame the individual because like the individual advisors, I do and I don't. I think if you are in this type of role and your job is to help somebody achieve financial goals, I think it is on you to make sure you're educated.
Yeah, that's what
I
I
do
was
think
thinking.
that. I remember talking to somebody that worked for, yeah, why not, Investors Group for their entire life.
You're just throwing
I don't even
everyone
know. I
under
don't
the
even know if this
bus.
episode is about to get out. But they were working for Investors Group their entire life, and they truly believed that Investors Group had better products than everybody else. Like that's truly what they believed. And it was like, I don't know why their Investors Group explicitly told them that. They probably didn't. I think they would have towed a line or something, but like they were very restricted on the type of products they could use, etc. until they went independent, and they're like, man, now I can have access to all of these different investment providers and funds. I didn't even know what I didn't know beforehand. And
That's
that's somebody that's been in the industry for 20, 30 years.
wow.
So, but I remember talking to that person, and I was like, "Uh, it's on you. Like, in my opinion, it's on you to make sure that you get as educated as possible, because ultimately that them clients trust you,
Yeah.
right? Like this is it. But then I,
That's
I go back and forth, right? Because I also know not everybody's like me in that they like some people like it's just a job, right? So it's and if they got rid of everybody that wasn't like me, then there'd be very few planners left, right? You know, like which wouldn't be enough to go around, etc. Like I get that. It's just because I am so passionate about it, I really hate to see people, in my opinion, what it feels like abused
Mhm.
because of lack of financial literacy,
Yeah.
where a rational person wouldn't make these type of decisions, and they're kind of being sold this half truth that is not a lie,
Yeah.
but isn't the whole picture. Because I can assure you that maybe I'm wrong. And there's some insurance advisors that do truly show them the cost of this. But I can't imagine somebody saying, an insurance advisor that can only do insurance, saying, hey, there's this one option. It's a really bad option. You should probably go across the road to Raymond James. You should probably go speak to the credit union wealth team because I can't sell you what I think would be the right. I just can't imagine them doing that, right?
Yeah.
Like
But again,
most,
it kind of comes back to that question of does the person even know? And that like it is like when I say the person, the advisor, the insurance advisor, do they even know that it's like, oh, we have this great product because that's all I know. That's where their education stops. So, do they understand? Again, I agree that it's your responsibility if you are calling yourself an expert in something,
to be an expert, yeah.
you should be an expert. And you said get educated. It doesn't stop though. I watch you constantly checking, like reading the news, watching videos, getting other like data, looking at what is accurate and true. And that I know that's like an important part of who you are fundamentally, but it does translate into work and your standard of work. I mean, yeah, take that as you will, because people are going to be like, well, of course you'd say that. You're his wife on the podcast.
Yeah,
Like,
of
I'm
course.
not trying to sell you guys. I'm just saying that is how he is.
Yeah, and it does color my it does make me I am very self-aware in that I do think I am maybe unfairly harsh on other people that call themselves advisors because of that. But at the same time, I think the world would be a better place if more advisors were like me in that regard, where you it didn't doesn't matter what head office is trying to tell you. You go out and you speak to people and you learn and you look at the data and like make decisions based on that versus what the wholesaler is telling you, or what your boss that you wonder, like coming from a company that is trying to get you to sell, like if you're working with RBC, for instance, and you look at your portfolio and you see all RBC funds, do you really think that is the best option for you
In every
in
single
every single?
person's different circumstances and life.
It's very unlikely, right? And what you find is that the reason I'm not a huge bank fan, you know that, but I would rather people work at these banks and invest at these banks and stuff, because at least what you find is the higher up, like let's say like RBC Dominion Securities, that's the investment brokerage. That's like what I do, right? Is like their equivalent is like their Dominion Securities. And what you find is the more experienced and the better the advisors are, the less they use like RBC's own product.
Yeah.
And that's not because RBC's own product is terrible. It's because the even the a hint of like choosing RBC's product just because it's RBC and that's where you bank or where you work, that hint of bias isn't worth it. And that's what you find when you go up and you look at like very high quality advisors, that because there's very good advisors and planners that work everywhere, right? Like
Yep.
it's about the planner, necessarily not even the individual. Even these insurance places that I'm talking about,
Yep.
there will be good people there.
Yep.
If you work at that place, if your investment portfolio is with these type of companies, you absolutely though should be more careful, right? And it's a pattern that it's not just me. It's like there's lots of very good planners and advisors that call this practice out because it is predatory. Like I don't know how else to say it. It'd be different. Like fees are one thing. Just because they're expensive doesn't mean that it's a bad product at all, right? Although I could get into that, but let's assume that's the case. At least the client needs to be informed, and not only informed once when they're going through a hard time, or when everybody knows, like any advisor, you know that your clients forget half of what you tell them as soon as they walk out of the door, right? Like this is a big enough deal that it should be something that is constantly talked about and revisited. It should never, like that other client, like your client as an advisor, should never walk into my office and say, I'm giving them a second opinion, and me say to them, hey, you have seg funds. This is costing you on average 2.9, 2.3, 2.7, whatever, high 2%. Why did you make this choice? And they look at me and they say, I didn't know that was the cost. Or my advisor said something about guarantees. It's like, no, if you are paying that type of price, that client should know exactly why, and they should be fully in, and you shouldn't be afraid of them getting a second opinion, because heck, if they're picking that choice, it's because you've told them this is objectively, this is the cost, this is what the cost is going to be, and you're choosing these benefits. And it's just that transparency is, I haven't seen it yet. Everybody that I have given second opinions to on these type of products don't know. And it's really sad. And I hate it. Makes me feel sick. Gross.
Yeah.
Just
It truly does bother him a lot. Like he will probably not sleep well tonight. And I know maybe a lot of people won't believe me, but I'm telling you, I'm not sleeping well if he's not sleeping well. So I'm
we have a
telling
riot, so that's half of it. But it's just so, it's like this difference, like this difference over this lifetime for this one fund, like you're talking about almost $250,000. Do you know what this person could do with almost $250,000?
yeah,
Like
that's crazy.
that's enough. If they have grandchildren, they could give that to them as a pre-inheritance and still be in the same place they would have been if they had picked the cheaper option. Like that is such a big gap. That's so much money.
It
For
is.
what?
Yeah, what are you paying for?
For what?
I was just going to say a quick side note when you were talking about how a lot of advisors call this practice out. I think the sad thing for a client, I'm thinking about it from their point of view, is like there's so much information out there. And like you said, it's like, where do you start if this isn't your expertise?
Mhm.
Like, you've already got who isn't busy now, right? Like, if you've already got so much on your plate, you're trying and now you're looking for someone to trust. It sucks that you may have picked the wrong person, and it sucks that you're probably not likely to come across content like on LinkedIn or other social media or like an
That you would
email group
understand,
that you'd
let
be like,
alone,
if
yeah.
an advisor is like, this is why seg funds are bad, are you really going to stop and read it? Maybe if you're invested in that product, but most people are just going to keep scrolling. Like
Mhm.
if you're not interested in this, it's like the information is out there, but
Because
it's
even,
not accessible
and
almost.
would you even know what to search for? Because like even
Yeah.
if you Google, like I was Googling like seg funds versus mutual funds, And um, there's like there's so many articles on it, like all across Reddit. It talks about it. There's like Money Sense has articles on it where people uh, like like send their questions in, and this person was talking about how I think it was their parent or something was in these seg funds and if it was worth it, etc. And I was like, well, for the cost, there's lots of considerations you have to think about, right? So the information is there. It's just I think a lot of people just don't know. They don't know the importance of it and the actual like dollar figures that they're dealing with, I think.
Yeah, and sometimes you don't know what you don't know, and it sucks that you go to these places and you want to trust that the person is the expert and they're telling you what's in your best interest, but that is not always the case. And unfortunately, we live in a world where you have to keep your guard up in pretty much everything now
Mhm.
because there's so many corrupt things out there. But I just feel bad for the client in that point of view, having to you're trying, you want to learn or you want to learn as much as you can, but you don't know what you don't know and you have to trust somebody at some point. So
You know what? Maybe you're right there. Maybe I should look at it like that. Like if the choice was between doing nothing, like this person with this fidelity fund, if the choice was between not investing this $500,000 or investing it in this fund that's really expensive, I guess it's better that they invested it.
yeah,
Like this what did it turn to $1.48 million is a lot more than 500,000.
in
Or if they'd have put it
cash.
into GACs,
Yeah.
like it'd be even less. Like I guess that's a good way to think about it.
That wasn't totally where I was going, but that's an interesting take. I was just thinking it's like you have to trust somebody at some point, and I guess for me the bigger like I want to say philosophical question is how do you trust someone? How do you get to a point where you trust that this is in your best interest? I think knowledge is part of it, but at some point, are you really going to learn absolutely everything? Or are you going to bite the bullet and trust the person who says they're an advisor advising you? Think about that. Like you are an advisor to these people. That's what you're calling yourself. They should be able to trust that you have their best interests at heart.
And maybe this is like a comment to other advisors or other people that call themselves other advisors, where it's like if you as an insurance agent, if you don't take the time to educate yourself, you may even think you're doing the right thing for these people. Doesn't matter if you think you are or not. It matters if you objectively are or not,
Mhm.
is what really matters.
Unfortunately, the math is
Math is math.
absolute.
Yeah.
Yeah, there's only one
Like,
right answer.
yeah.
Do you want more money or not?
It's like, oh, you just be informed. I mean, like looking at like there's this like I'm looking at an article right now. It's like an honest comparison, seg funds versus mutual funds. And it talks about like the cost. And that's but it doesn't it says like the fees associated with seg funds are usually higher than for mutual funds. This is to cover the cost of the insurance features. And it's like, okay. And then it says mutual fund advantages, lower costs than seg funds. The management expense fees are normally about 1 to 3% of your holdings, which is less than segregated funds. Over the long term, reduced management fees can make a huge difference to the growth of your portfolio. But what does huge mean, right?
Mhm.
Even if you're reading that, do you really understand how big of a difference that makes?
Yeah.
Like I showed you, I was talking about over like a 10, 15-year period. You know what that looks like for a 30-year period?
Yeah.
It's so big. Yeah, I just is what it is. I can't save everybody, but it is a practice that I just hate to see. And I just, yeah, if I could wave a magic wand and have everybody have good enough financial literacy to make informed decisions regarding this practice, or all practices really, but this one in particular, because I think this one hurts a lot more people than because they get the swings of the market as well. Like it's just, yeah, it's just
Yeah, they're paying for, well, in a lot of cases, it sounds like not much. So,
Really not. But it's just like every down is bigger. Like I'm looking at 2016 for this, and like the regular fund was down 1.99%. This fund, because of the fees, guess what? It was down minus 3.03%. And then every up, like in great years, 2020 was a great year. The normal version was up 20%. The other version was up 18.9%. And it's just like that difference that every down's bigger, every up's smaller. It adds up and it makes a difference. And it's just, you can't make it back.
It just compounds.
Just compounds.
Yeah.
Just. Anyway, is what it is. Can't change everything. It's just
What a
ran
sad
over.
episode this has been.
I know.
We can't end it
No.
on a bad note like this.
Yeah. Wish I should leave it on a positive note. The positive note is this. If you feel, no, not if you feel, if you are currently working with a company that, well, let's do it the other way. If you are currently working with a company that isn't an investment company or a bank, you should take you should get a second opinion from, I'm obviously going to say, go get a second opinion from like a credit union wealth management team or something like that, because that's, come to me for a second opinion. I'm obviously going to say that. But go to a company that is investment first to get a second opinion.
Yeah.
So like if you're working with Quadras, if you're working with Fairfax, WFG, La Capitale, like any of the Sun Life even, honestly, I have seen pretty good things from Sun Life and Manulife. I think they've done a really good job of differentiating the wealth management piece. So I would still say you should go get a second opinion, but I would be less, I think percentage wise, I think more people are in good quality, lower cost portfolios with those companies than these other ones that I listed. But if you are with any of them, any insurance company, go get a second opinion from an investment first place, like a bank or a credit union, like a wealth management team or a credit union, or Edward Jones or Raymond James, somewhere that is wealth management first. Yeah. Just see. Just go get just see.
Like, should the person be a certified financial planner?
Absolutely. I think that goes without saying. Probably doesn't go without saying. The person you deal with should absolutely have earned their CFP. Now it's been said. And that should be the minimum standard that you should be willing to take advice from, in my opinion. But again, I hold myself and others to a much higher standard than the industry does. It's just, this is your money, this is your life, this is the money that you're going to pass to your kids and your grandkids, or like going to fund your retirement. Or like these are not small decisions that have no impact to you. These are big decisions that do. So it's much better to at least take the time to trust the right person, right? That has the right tools.
And just know the information. Get someone to help you run the numbers. Let's see what the actual numbers are, what the dollar figures are, and then when you can make a decision from there.
Yeah. And get a few people's opinion, like, because there's a lot of people out there that, like, even I've offered second opinions on investment statements, and I've said to them, while it's not the way that I would do it, this is fine. Like, it's, yes, do I think my way is better? Yes, otherwise I wouldn't do it this way, right? But like, there are levels of badness for a portfolio, I guess, and high cost seg funds without the benefits, that when you're not really gonna achieve them, is pretty low on the list of goodness for a portfolio, right? So it's like, even if you go to the investment advisor or the financial planner and you say, hey, I'm not looking to move my investments, I just want a second opinion, I'm willing to pay for your time to get a second opinion, and you do that once every 5 years, I think that's a really good decision for a lot of people, because at least you know in that way. But
that's worth the cost.
Yeah, absolutely.
Benefit and cost analysis, is that what you'd call it? I don't know. It's worth
something like that. That I would agree with you. I think that's worth it for sure. Okay. Anyway, I think I ended that on a good note.
I think so.
Okay, good.
We're gonna wrap it up because this is another long episode.
So. Okay. Oh man, it's 50 minutes. Okay. Well, we will see you in the next one.
Bye.
Bye. Thanks for listening to this episode of the Plain English Finance Podcast. Trey Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities offered through Aviso Wealth, a division of Aviso Financial Inc.